Okay, so today, just now I'm going to take on this subject, why is investing so confusing? And lot of people have been asking questions whether this is right, or that is right. And it's not your fault, because this is a very vast subject, and that's the reason it's really confusing. And this session is going to deal with more of understanding investing, the investment planning which is required, then the paradigm of money, and what sort of financial literacy is really required to understand how you manage your finances. Now, this is a very large subject. So, different people invest in different things. Some people have a large family, so that the more sons they have, the more better they'll be in their old age. Then, some people invest in good education. The more better you are, the better jobs you can get, the better lifestyle you'll be able to live. And then, people invest into assets, so that assets over a period of time will start earning them interest, or they can sell the assets in times of need. So, different people invest in different things. So, for them, each one of them, investing is a very different thing. Then, to confuse more, we have different types of investment products. We have different types of products like stocks, bonds, mutual funds, real estate, insurance, precious metal, commodities. So, you have people investing for certain reasons, then you have different investment products and different investment procedures. How do you invest into those? Suppose if you're going to buy, hold and wait for a long time, you are a long-term investor. We are just buying and selling, selling and buying, you are trading. If you sell and then you buy, then you are shorting. Then you again have option trading, the derivatives market, and you have brokers who make you trade. They themselves don't trade, but they make you do a lot of trading so that they can make money out of it. Now, along with these different products, investment procedures, you have different classification. A stock trader, a person who is trading in stocks. A real estate speculator, the person who buys and sells real estate. Then you have collector of arts, who also when the price goes up they sell. Commodity futures trader, day trader, saver having a bank deposit. Now, all in all, in the guise of investing, you have people speculating, people gambling, doing all sorts of things to make a fast buck. Now, why is it a large subject? Because the appliances we use, today the cameras which are there, the air conditioners which are working, the tables and the chairs, the lights which are there, these are all things which we are using, made by companies where someone has invested in. The electricity which we are using is also supplied by a utility company where someone has invested in. The car which we drive, it's made by a company where someone has invested in. So, investing is all around us. Everywhere if you see, there is some sort of investment done by certain people, and that's why we are reaping the benefits. Now, trading, which a lot of people would call that I am in the stock market, I am investing. It is not investing. It is actually a procedure or a technique to deal with a certain investment product. Today, under the guise of trading, people believe that they are gainfully employed and gainfully doing an investment thing. If you ask any day trader, they'll tell, well, I am in the investment game. He is a trader because he is in the stock market using stocks or derivatives as a product and a procedure of trading or a procedure of speculating. Now, why do we have so many different types of cars? Because different people require different cars. Now, for a couple who are living in a city, a Maruti 800 would be the right vehicle to use. However, for a farmer who is in the rugged lands in the village, for him, Tata Sumo would be the right way. That's why for every individual, we are using different type of cars. Similarly, we are also using different types of assets to take us to our goal. Now, different investment products are nothing but investment vehicles. Now, for us, if we are at a comfort level of A, and from there we require to go to a comfort level of B, we require different types of investments. Take the example that today we are at Goa Institute of Management. From here we need to go to Taj Vivanta. Now, how many ways we can go to Taj Vivanta? We can either walk it up, we can take a bicycle, we can take a taxi, we can take a car, we can take a bus. Now, these are the different types of vehicles we will take to go from one place to another. Similarly, in your investment plan, you have to have a plan to go from one level of comfort to another level of comfort. And in that level, you would require a lot of different types of investment vehicles which you will require to use, and once they have served their purpose, you will switch your investment vehicles. So, investment plan, investing is actually having a plan. It is not a product or a procedure like trading. You have to first know your goals. You have to know what are the type of pains you want to take to save certain things from the revenue stream which you get. Then you will have to have milestones where you are going to be spending certain things out of compulsion, spending certain amount because you want to achieve certain goals, and with that you will have a discipline to stay the course or not deviate from this course. That is all about investing. Investment planning requires, first is a disciplined approach, a proper asset allocation which would insulate you from market volatility. Then you should have the control and the flexibility to change the course whenever times change or circumstances demand, and a clear vision where you want to go. Now, it is for all these purposes that your behavioral anomalies would be really coming in handy. That when you have to really have a clear vision and not stray the course, that's the time where all the small temptations in life will help you to see to it that you are perfectly disciplined. Don't allow your heart to interfere with your mind decision making process. Now, there are two sources of returns from the stock market. One source of return is fundamentals, which are represented by its earnings and dividends. You buy a company, what is the dividends you get, what is the company which is earning is going to give you as dividends. These are the fundamental things which you see in a company. Now, the price of that company is quoted at an X rate. And another form of return is speculation. That is, some people believe that the value of the stock is more than its fundamentals or less than its fundamentals, and they buy or sell. Now, it is betting not on the fundamentals, but betting on whether the price of the stock is according to the fundamentals or not. So, when you are speculating, you are really not bothered about how good or bad the company is. You feel that the company is better than the market, so then you may be buying it because you believe that the market is wrong. If you are selling it, you believe that, well, the fundamentals are wrong and I believe that the market price will go down. That's speculation. According to Graham and Dodd, what is the definition of investment? One is, first is you got to be thinking about preservation of your capital. Then expect a reasonable rate of return. Most of the time, just now we get carried away by 40% return, 50% return. That's where you always go on losing the money. It has to be a reasonable rate of return. If your interest rates are around 7 to 8%, equity risk if you are taking, expecting a 15 to 20% appreciation over a longer period of time would be the right thing to do. Now, in so doing, Mr. Market can sometimes give you a 50% return or a 10% return. That's where your emotions will come in handy, to understand, well, these crazy times cannot last for long, and then you make your investment decision based on what sort of stupidity is going on in the markets. And it has to be from own funds. Today, the banks and all are after you, telling you, take this money from us, you buy this land, buy this flat, it's fine. But when it comes to buying a stock and you think that you are going to invest, or even taking loan and buying an IPO, or even taking loan and buying a bond which is a fixed income security, all is speculation. Because the basic tenet of investing is that you are saving throughout your life and putting that money to use. So, operations which do not meet these requirements are all speculative transactions. I have discussed the law of the farm. You cannot sow something today, reap tomorrow. A seed which is planted has to go through all the seasons till it becomes a fully blown tree. And that takes time. So is the case with investments. That you just cannot buy today something and expect that you become rich tomorrow. These are only illusions. And if you are going to get carried away by the illusions, you're going to feel sorry when you have lost all your money. Now let's understand the paradigm of money. When it comes to money, we are always guided by fear. Fear of losing it, fear of not having enough, envy or fear of not having so much as the other person is having. So whenever we are thinking of money, we are always thinking out of the paradigm of fear. Passion does not drive us. Give you an example. If you go, one day you will be all out of college, you will be taking up jobs or starting a business or whatever that is. And when you take a job, you will have certain desires you may be thinking just now. It's only a question of some time that you will be out and getting your salaries. And you have certain desires to be kept. And you, at present, what you would be thinking, oh, when I get the money, it will solve all my problems. Money is not going to solve your problems. Because if it was that simple, then the richest man in the world would be the happiest man. But you go through that and they are the most saddest of the people. You get a job, you have certain desires. Comes the first paycheck. You feel very happy. You spend it on your desires. Okay, it should be very good. You got your salary, all the desires are met, you should be very happy. Doesn't end there. After a couple of months, you will have certain more desires. And again, you are looking for those. And those desires, since pleasure becomes boring over a period of time, those desires would have increased. If you have a salary of 50,000 rupees, then your desires would see that the salary of 50,000 will not match it. You will be always looking at more and more. So you are always looking at your job or at your boss who gives you the salary or gives you the job that, well, he is the one who is going to solve my problems. Because you are looking at getting more salary because your desires have increased. So you have entered into the rat race. That every point of time, your desires go on increasing. You are looking at the job giving you the money, you getting the money, thinking that money is solving all your problems. Money is not solving all your problems. Because you have become your worst enemy because of your desires, because of your lack of discipline, because of your lack of financial planning. And at every time you are thinking that money is important, money is important. So what we do is, most of the people, 80% of the people I would say, the paradigm of money is starting with fear. On the contrary, if you want money, passion should drive you. Why should fear drive you? Passion of making money, passion of doing certain things. And if you are going to be doing that, then I am sure money will ultimately flow. I have seen that every passionate person who has done certain things, even if he was not educated, even he didn't have, but it was the passion which drove everything. So tomorrow, when you are looking at money, you should be thinking, I want this money, I want to do certain things, that's why I'm going to earn this money. It has to be out of a paradigm of passion. And this is very well brought out in this book. Yesterday I couldn't remember the name, The Secret. I don't know how many of you have read it? only a couple of things. I think that should be a bedside book. It gives you a lot of confidence that you can do everything from a paradigm of passion. It's not only daydreaming, but you got to dream about what you want to do. And when you are dreaming about that, you require the money or you want to earn the money. Think of it. If it is fear, then you are always going to go backward. Why? Because all this loss aversion is always going to be putting you backward. Decision paralysis will always put you backward. All these behavioral biases are against you when you are going out of fear. So money is actually a form of power, but more is your financial literacy. That how do you really look at money. It's looking at money which is financial literacy rather than having money with you. So ultimately what we have to think is, let's use the emotions to think rather than think with the emotions. What we always do is the emotions control us. We have to think with emotions. What is a house? What would you call it? Would you call it a liability or an asset? Asset. A house is only an asset if it has been bought from one's own money and is used to earn rent. It is a liability if the house is bought with a mortgage and monthly installments have to be paid. Because of your lack of understanding of the basics of finance, that you call it an asset. Because you have to consider that what is an asset. Asset definition is only one thing. An asset is something which creates an income for the owner. And liability is something which creates an expense for the owner. Beyond this, there are no other definitions of assets. So a house, why we believe it's an asset? Because it is a mental heuristic. It's something like tips which I mentioned yesterday. There are certain things we just know that, well, I need a house because it comes in the asset column, and that's why it's an asset. Now imagine if you have a mortgage on a house. So you are paying every time the mortgage charges. It is not owned by you. The banker comes and tells you, I help you to buy an asset. So you are very happy. You tell, well, make me buy an asset. So you take a loan from him. And he makes you buy a house. So you come home and tell that I have bought an asset. But does it really belong to you? Till you pay the mortgages, it's not going to come to you. You may be using it, but the day you stop mortgages, you're going to be out. And is that asset creating an income for you? It's creating an expense for you. Because you have not paid off the mortgages, plus you have not paid the interest rates which they charge on the mortgages. So in the realistic sense, it is a liability if you have stock. Now if you own a house and if you just keep it locked in your balance sheet, you should consider it as a liability because it is not earning anything for you. You are paying the society bills, you are paying all those to maintenance. So something is getting out of you. Now these are the basic tenets of finance which you have to have in your mind. Doing financial management or anything is not going to help you if you don't know the basic. That if you are MBA students and if you don't know that if a house is not an asset or a liability, how are you going to take on the financial decisions which will have to come your way in your life? A lot of other decisions will come. Now, this is the profit and loss account. Asset will give you an asset cash flow because it is always an income. This is the liability will only take your flow out because it is an expense. Now, this is the profit and loss account of a poor person. He has a job, he gets a salary, taxes, rent, food and others, it's just spent on his on his day-to-day requirements. Every day he is living a life where he is getting money and he is spending it. This is the cash flow of the middle class. They have a job, they have an income, and they create liabilities. That is why you have 80% of the people in the middle class category. How do they create liabilities? Because they are looking at money from an angle of fear. They are looking at money solving all their problems. They don't have any self-discipline because they are looking at instant gratification. If the neighbor has a car, I want a car. If the neighbor has a house, I don't mind mortgaging and getting a house. If they have a washing machine, so what if I don't have the money? I will take it on rentals. So they go on creating liabilities. And when they go on creating liabilities, why they are only in the middle class rut is because every time the salary or the income increases, they start creating liabilities. That's why the profit and loss account is something like taxes, mortgage, clothing, food, fixed expenses, credit card bills, everything. Liabilities would be mortgage, car loans, credit cards. Don't make your balance sheet this way because you will never be able to come out. You have joined the rat race. That you don't want discipline, but you want to show that you got a lot of things which you want to use. You don't have self-discipline, so you want to borrow and use. And today, everywhere you will be able to buy everything. Even holidays you can buy by borrowing. Now, the environment is only controlling you. It's up to you how you challenge that environment and tell, well, this is not for me, I don't go there. Because my job is to create assets. Because you all would be in the 20s and 30s, and at this age, your job is to create assets if you want to be out of the middle class race. People stay in the middle class is because even if the income rises, the expenses rise much more faster than the income. And they have no assets or very few assets, and their liabilities are always more than that. That's why the lure of a good job should not make you happy. Yes, if it is a good paying job and if you enjoy the job, because if it is a passion you are doing something, go ahead with it. But don't think that job is there to solve your problems. Your job, the money which you get is not to solve your problems, but to create further assets. Because then only over a period of time, you will be able to have a better life. Now, this is lack of financial literacy, which make you do what the masses do. Now, first is, you have a job, so you are working for your boss, it's said and done, because your employer is the guy. Then, you have to pay your taxes, so you are already employed by the government, because regularly, you go on paying the government. Then, when you go on creating liabilities, you take a third job for you. You start working for the bank. And what an asset has to earn for you, you are not doing anything about it. So, you want to be in this rat race, you can never come out of the rut because you will be only buried into debts. Now, what differentiates the middle class from the rich? It's not that rich are rich just because God wished them to be. Because rich people, they go by certain disciplines. They understand that you have to work for money, and over a period of time, that money has to work for you. That is why people become rich. People don't become rich because they have got some magic or anything. People become rich because they believe in the universal principles of looking at money and spending it wisely. It's not that they don't spend also. They spend it, but only after creating assets. This is how people do that. Now just imagine, if you were to from whatever your income, if you start building up your assets, how would your profit and loss account look? Very few expenses would be there. Your income would be by dividends, interest, rentals. Your balance sheet would be assets with hardly any liability. Now believe me, It is not that difficult to do that. Only it requires willpower and your ability to delay instant gratification. If you are going to do that, and that was the reason of my first lecture, that everything which is going to differentiate your life from the mediocre life is going to be your ability to delay instant gratification. It is highly possible by anybody who wants to stay the course. It is difficult because if you don't buy a car and if your peers are buying a car, then you should have the courage, the moral courage to tell you, so what? I'll buy a car when I know that I can afford it out of my assets. I think that is the discipline which is required, and you should develop that discipline. This discipline doesn't come. What is your integrity account? When every day you deposit in your integrity account by doing the right things, you are able to create an integrity account. Every day if you go on withdrawing, then again that withdrawing, spending, it becomes a habit. And when that becomes a habit, ultimately it affects your character and your actions. This is the cash flow of the rich. Assets are owned, income is earned from the assets, expenses are met from this income, balance is used to create more interest. I think everyone should have this chart over there. This is the way, this should be the goal of every financial plan which you make. This is what makes people rich. This diagram. Beyond this, there is no other diagram. Go on creating assets, they will create income for you, and they will. Now, to be rich, you don't have to work for the money. You have to make your money work for you. And that's why investing is very important. And when you are investing, how you treat with that money, your behavioral anomalies, your structure of the mind and the heart to really equalize between greed and fear is going to be your testing times. Why must one be an investor? Now, there are different cash generators which ultimately work for you. In all our life, all of us, if you are an employee, you get cash from your job. If you are self-employed, you are owning that job. You are a doctor or a lawyer or something, or you are an advisor. You are owning a job. If you are in a business, you have a system in place, people work for you. McDonald's, hamburgers. I think in our house, in any of your houses or any of the ladies, you would make better hamburger than what is made by McDonald's. You'll all agree with me. But McDonald's has a system. Millions of hamburgers produced, reaching through a system, at a place to be sold to people at the same time. Different types of people working for it. And that is a business that it can sell even mediocre hamburgers and make money out of it. That's the power of a business. And if you have three of this, everyone would aspire to own a business. But everyone may not be really, I would say, blessed to own a business, or maybe not having enough capital to own a business, or maybe not mentally set up to own a business. Fine. But the goal would be to become a minor shareholder. That's buying a stock in a company and understanding a business and being a part of that business. So the goal of every individual today, if you want to live good lives, if you want to build up assets, your goal has to be an investor. You could be in any business, in any job. This is something where you are not controlled by any regulation not to be an investor. And if you believe that investing is going to create assets and those assets are going to make money for us, then I don't think that there are any two opinions or a decision paralysis where you want to be or don't want to be an investor, because you really don't have a choice. At this age, you are young, you can do a whole lot of things, you can dream a whole lot of things, but in future, it is only on these things you can fall back on the right investments, the right work you have done in your own. Now, even I was young, your age, that time we also had lot of confidence that okay, we can do this, we can do this, we can do this. And we thought that nothing can go wrong because we were young and we thought that we could always have our way. I don't know if you are aware of that song. Those were the days. Once upon a time there was a tavern. Now it's a beautiful song of how in your young days you are so excited that you think that you can always have your way. Over a period of time, even I have realized that aging is something you only know when you age. Otherwise you'll never know. So all those advices which may come to you will definitely fall on a deaf ears till the aging process over a period of time will start showing you the real powerful ways of the universal principles by which we are governed. As I told you, the best way to invest will be to own a business. And if you can't own a business, then you buy stocks. Yesterday I mentioned to you about how stocks are the best hedge against inflation. You are buying a business which sells a product or a service at a profit. This profit is distributed to you in a part by way of dividends. Rest is plowed back into the company. In times of inflation, when everything becomes expensive, competitors cannot come into this line and this company develops a pricing power because of its stay in the business. Secondly, the ease of handling. Just a demat account, a internet stockbroking account and a bank account. Most tax efficient asset. Dividends are tax free. Long-term capital gains are zero. Just a little bit of short-term gains, which is good because it will avoid you not to get into the trading habit. And if you are investors and if you take it upon that, after we reach the age of 70, when we become old, the society tends to discard us. You are old, you don't know. Limbs give way. You are not in the limelight. But at that point of time, this is a fantastic old age hobby also. Because when you are owning stocks, you have learned something about stocks, you have learned something about businesses. When you don't have a job or when you are retired, how are you going to pass your time? This will be a fantastic hobby. At the same time, you have learned how to look after your own money. You have learned to earn your own money. That time, reading a newspaper would normally be boring because you are out of the system. But if you are an investor, it will make sense for you to even take about 2 to 3 hours on the newspapers, which you can spend quality time. The right way, delay gratification at any cost. That is one strong principle each one of you should have. Only think long term. There are no shortcuts. I am telling you, I am a part of the stock market. I have seen so many bankruptcies because people went in for short term. Some of you over here may be doing short term. You may be making profits just now. I assure you that there are no profits. There are no profits. Over a period of time, you will have to give that money. Because making a profit and earning money in the short term also is a bad habit because it becomes a habit with you. There are times, I know of people, if they don't sit in front of the screen, they would feel, I would say definitely that they would be uneasy. They would have withdrawal symptoms like alcoholics have. They have to be in front of the screen. They have to see something, whether the stock market is going up or down. And when that becomes a habit with you, what you do is, you become a day trader. I don't know where. Have you seen that ad of ICICI? That person is going to office, so his wife thinks that he wears a suit, he wears a tie, everything, goes in the other room and sits down in front of the computer and starts trading. Now, this ad has two meanings. One is, it is glorifying something which you should not do. And I don't know how they allow such ads. If you say tobacco is bad, I don't know how they allow such ads to be there, because this is equally bad for the younger generation. But there are things, as I told you, the environment is so vicious that it is always taking you for a ride. It's always tempting you to do something which you just cannot do. And as you know, there are no shortcuts in life. There are no shortcuts. Thank you. I'll take any questions on this if you have.
So,
Yes.
what assets are we talking about? Because even if you just talk about shares, like you said, in a home, you make mortgage payments, so you're making your anchorage. Similarly, even if I just hold on to shares, I have charging which I'm paying to my TV.
Yeah.
Even there is an outcome.
Yeah.
In the house, that will be taking account the fact of capital appreciation on the house.
No, see, now, don't get me wrong, that there is nothing wrong in buying a house on mortgage. There is nothing wrong, because all will require houses. Don't get me wrong. What I am talking about, how do you treat that as an asset or a liability? I am not telling you don't take on liabilities, because some of you, if you don't have houses, you will have to go through that. But don't go home and tell your wives, or don't go and tell your husbands, hey, I've got an asset for you, if you have taken it on a mortgage, because you have bought a liability. So, there is nothing wrong in taking a house on mortgage, but you understand that it's an expensive way of acquiring an asset. And when you have a mortgage payment to be made, every time you have to understand that till the mortgage is not paid, it is not an asset with you. Now, what I'm talking about investing and stocks. Stocks is a very dynamic thing. Now, stocks, you are buying a business. When you are buying a business, what you do is you are looking at long term, that over a period this business will give me money. So at that point of time, you cannot see that I'm spending so much on on my demat and all. Now tomorrow you get married to your wife. Now tomorrow, because she comes to your house and she eats and all, if you count those expenses, don't consider as a liability. Yeah.
So from your career, can you share any instance where a stock was very mispriced just because of behavioral anomalies in the market?
Yeah, one is which I have already shared with you in 2008. The behavioral anomalies were so strong, like Emphasis was at 130 to 160. Oracle, we bought it 440 rupees. We had bought it at 950 rupees. We liked that stock very much. It went down to as low as 440 rupees. And just now it's about 2200 rupees. Now, this was behavioral anomaly at its peak. Means everything was down and out, and there you took it. So this is something which everyone can relate to. But there have been certain times, different stocks, and I believe it is happening today. Something like an ILNFS Invest Smart. Now I'll explain you the business model of that. It's investment manager, sorry, not ILN. It's quoting today at around 36 rupees. Now, it's available at about 3.5 to 4 times dividend yield. And it's got a fantastic business. First is, it's got the first mover advantage because they started in 94, 95. They are into private equity. So any big money has to come for investing in the Indian markets. It comes through ILNFS Investment Manager. Now, they have this money coming in for 7 to 10 years. Big money. They charge management fees between 1.5% to 2%. Then, after the end of the project of 7 years or 10 years, there is a profit sharing also. That 25% of the profits go to the company and 75% this thing goes to the investor. Now, see this beauty of this business. You require least amount of capital, just an office space which can be leased out, and smart people who are working over there. Now this company has people, the senior management who started with them in 95, they are still there. And they are one of the best PE investors. Now those people are still there with them. They have a good knowledge about where to invest, how to invest. They have made good money for their clients, and the type of new money which is coming in through them is mind-boggling. Now this is a beautiful business that mark to market they are not dependent upon. If they got some money every year, they will go on getting 1.5 to 2%. Now that is a predictable income stream I am seeing. Then at the end of this, if there is a profit, again they will get the money. And new money always goes on coming, which is locked for 7 years. It's not like in a mutual fund where every time they think if there is a outflow, a day-to-day outflow is not going to come in this business. It's a very robust business design. Now today something wrong is happening to this beautiful business. Is there could be someone who may be selling consistently in this counter, or because the sentiment is bad and they have made one acquisition and the analysts in the market believe that that acquisition they have paid a very high price. Now those guys who are making an acquisition, they know what they are doing, rather than some analyst who is working in a broking firm comes out with a report that, well, they have not done the right acquisition. So you are having all these sort of rumors, and that is the reason this stock is being beaten down. Now this is where you require the courage to understand, am I buying the right thing? Am I doing this? This has been really down. It's a behavioral anomaly working. You can buy that. Yeah.
Even in this case, how would you decide that the price is the right one? Because the business would have been the same, say 1 year before. The same people are there, the same business model are there, and the same people are right now, the same business model is right now. So, as I as an investor, how do I decide whether 1 year back was the right time? Because you have to finally look at some numbers.
No, I'm telling you, yeah.
Can you tell us?
I love this stock. I bought this stock at 43 rupees.
So how did you decide the point?
No, I'm telling you, I'm just explaining. I love this stock at 43. I bought it at 43 rupees. Then the new quarterly results and all started coming out and their profits were growing. I bought it at 50 rupees also. Now, I don't know, at that point of time, I didn't know whether 43 was the right price to do. But I understood one thing, that at 43 price, it was at 3% dividend yield. A beautiful business, available at a good PE, and I wanted to be in that. At 50 I did that. In hindsight you will feel 50 I made a wrong decision. No, I had never made a wrong decision because I believed in that. Because at 43 I liked it, at 50 why did I like it? Because the new information which came, the new quarterly results which came, they were always growing. Now today those have been growing and the price is going down to 35. It makes me more confident. Why does it make me more confident? If you saw Daniel Kahneman, that what is the information you have? You have this information, then it cannot take you away from your decision. So, right price, there is no right price because there is a Mr. Market, as I told you. One day it is in an intoxicated mood, one day it has a hangover and it quotes different prices. It's up to you. What price do you like? What business you like? I like this business, so I will stay invested because over a period of time, everyone will realize that. So like even if you may call me an expert, I consider myself as no expert, even I am still learning. There is nothing like a right price. Yes, when I bought at 43, it went to 50, Parag Parikh is a genius because he bought it at 40. No, I didn't know that it was going to go to 50. Price is a different function. Similarly was the case in Emphasis. Taken over by HP, 2008, available at 3.5 times to 4 times earnings, a company like this. And every quarterly result which was coming out was growing up, was showing a growth of over 25%. And the stock was going down. That's an opportunity. But at that point of time, you require a lot of courage, lot of guts to buy that stock because everyone is selling the stock. And investors' psychology is such that they find the stock less risky when everyone is buying and prices are going up. That time everyone wants to join the bandwagon. They find it more risky when the prices are going down and when they think nobody is buying.
So you rely on unaudited results, the quarter unaudited.
See, very honestly, I just take these quarterly results and all as a reference point to just check whether things are going right. But otherwise, as I told you, I really rely on the quality of the management, the quality of the business which I am buying. Any questions? Yeah.
Do you pay any attention to insider buying that's reported in the papers? Insider buying, selling by insider?
See, I'll tell you, all these newspapers and all, they think, what is their job? To give you news, correct? Now, what they are doing is, they are giving you tips. So, do you want to really listen to that? A newspaper is for news. it's not for investment advice.
So not advice. Like every company has to report to the stock to SEBI when
Yeah.
key management personnel buy or sell. That gets reported in the economic times for sure.
Yeah.
So do you place any?
Not at all. No.
You just made the statement that what will an analyst know about an acquisition? The management knows what they're doing.
Yeah.
So isn't that?
No, but how does that? They bought this stock. It's new. See, today stock market goes up on rumors, and people sell on news. They buy on rumors and sell on news. Secondly, this is an event which has happened. That's why a balance sheet will tell you whether the financial state of the company is good, but is at a particular date, 31st March. So now in December, if you are reading that balance sheet and thinking, does it tell you anything? Because we are in a totally dynamic world where things are changing every day. Businesses are changing, business models are changing. So how do you know from that? So, okay, they have bought stocks. Well, it is something which is in the papers, so it's information which is available to everyone. Now, can that information really have a bearing? It can have only a temporary bearing. They think in the market, in a bull market, if they write, FI bought so much stock there, and then people will start that and it will go up. In a bear market, they think if they write, FI bought so many stock, the market will not move only. Because market moves on sentiments.